One of the great things about this particular module that we'll be going over is, along with some sales concepts, we also have a platform that you can use with Global Atlantic to help develop this concept and provide it as a potential solution to your clients. So with me today, I have Brad Newcomb. Brad Newcomb's an RVP in the Great Lakes region. So some of you on the call may get to interact with him on a daily basis, working with him within that region. But Brad's been gracious enough to join us today. A really good resource we have here at Global Atlantic. He's able to break down concepts, explain them in a way that makes sense both to the agent and the advisor, and also kind of to bring in that client perspective. I think he does a really good job with that. Joining him today is Lena Storm. Lena Storm's an AVP in our advanced sales area. A good knowledge base of concepts like we're going to be reviewing today. And you're also getting to work with someone when you see the system that she'll show you that we have. She was on the ground floor of that, creating it and implementing it into how we use that today. So two great resources and two great speakers that we have. And I think you're really going to enjoy it. Brad, Lena, floor is yours.
Excellent. Thank you, Kyle. And thank each and every one of you for joining us today. I appreciate you taking some time out of the busy day. I know that busy may be different for some of us as we're used to, but I think what we've tried to do at Global Atlantic is, take the ideology of a spring training that baseball teams go through every year and kind of put that into effect now as we hopefully are nearing the end of some of the stay-at-home orders and things of that nature, and can get back to meeting with our relationships and clients. And I, for one, am super excited to be able to get out and help advisors and agents and my distribution partners to expand their business and pick right back up where we left off. So today we're going to talk about the Secure Act, and there are a few different points of the Secure Act that we're going to cover. But I think the biggest thing, and one of the things that Lena and our advanced markets team have been able to do, not only on Secure Act, but as Kyle mentioned previously today, we talked about the CARES Act, is as new legislature comes out, we are able to go through and give you resources to have meaningful conversations with your clients, whomever they may be, and break down what that legislation really should mean to them. So if I look at the Secure Act today, the Secure Act was about 125 pages long. There were 30 different provisions in there, and really the emphasis of the Secure Act was to bolster retirement savings for people in the United States. And so what we did at Global Atlantic is came up with, number one, a quick concepts piece that put this into 8 key points that really go through and tie into the life insurance and financial planning business, and put those available. So the first thing, and one of the biggest thing that we're going to hit on today, is the changes that beneficiaries of IRA receive, or the abilities that the beneficiaries of IRAs have as deaths occur in 2020 and going forward. We're going to talk about that and talk about some different ways to approach maybe a more flexible way to address those concerns of your current clients of passing assets on to the next generation. So I think that's the biggest thing and most impactful. The second thing was, a tax credit for planned startup costs. A lot of different employers, especially smaller employers, didn't go through and set up plans due to the costs associated with those. And so inside of the Secure Act, they gave a credit up to $5,000 to be able to start a plan, in hopes to give more individuals abilities to start up a retirement savings plan sponsored through their work. Next, on top of that, was multiple employers can go through and kind of put a singular plan together before they had to be from the same industry. This allows them now to have different industries and be able to combine in efforts and reduce costs and share in costs to start up plans. And so that's another piece that came in. The final thing, not the final thing, but the fourth point was, allowing more people to participate. It used to be for a full-time employee, we're the only ones able to participate inside of these plans. Now they've gone through and really taken the threshold of number of hours worked to 500. which definitely gives people that are part-time laborers abilities to participate in plans where under previous legislation they could not. One of the other big things that happened was they did push out required minimum distributions to age 72. So that was another change that may be impactful for people that weren't needing those IRA assets to supplement their income during the retirement years. On the other side of that is now people that are 70 and a half and greater can contribute to plans as long as they're still employed and have those earned income features. And then one of the top things as well that I think plans have gone through and done, and this is really that transition from pension plans that were fully funded and sponsored by employers and putting that over into the defined contribution side, is how do employees spend down those savings that they've had, being as though there's not a structure in place like we used to have with pensions that was made readily available to many, many different employees. How do we put annuities inside of these plans that allow for them to take lifetime options to spread out that income, give them a format to take that income that they will not outlive, and make sure they spend that down the appropriate way. And the eighth point is, 529 plans can now be used for student loan debt. And so I think that was another feature that really gave more flexibility for those plans due to timing of maybe when the education cycle was hitting and those students were hitting the colleges and universities. And if we were in a down market, it wouldn't be a good time to start drawing down those 529 assets. And so, 8 key points that we really put into a very simplified format for you to be able to have those discussions with your clients and prospects as well. And so, really what's the biggest opportunity that we found? And that is the IRA Max solution. And this is a solution that's been around for years, but I think because of the Secure Act and the elimination of the stretch IRA or life expectancy distribution out of an IRA for a non-spousal beneficiary, this is more prevalent than ever, and I think allows us the time to educate consumers, clients of how these assets really are going to be passed on to the next generation and what options are available. I started off my career in the annuity space and discussed stretch IRA as a distribution mechanism that we allowed for inside of our annuity products, and those have now been taken away. And so, really, how can we have that discussion? How can we go back and talk to those people that may have liked that idea, went down that route, and now that's been taken away? Let's talk about a different solution, which is the IRA Max. And so we want to look at an IRA owner who has specifically designated that IRA or qualified plan asset to be passed on to the next generation. They're not going to use that asset to go through and live off of during their retirement years. Secondarily, they're 60 years or older, they're past that 59.5, 10% excise tax window. And then finally, the IRA owner understands that it's going to be used, that they're going to be drawing down that IRA asset. There will be taxes due for them on an annual basis, of course, because there'll be a 1099 generated, and that's going to be used to purchase a life insurance policy. So if it doesn't fit that parameter, this may not be the right solution there. And so, when you look at 2 parts, we're going to break this down for those abilities that were available in 2019 for deaths that occurred there, and then for deaths that occurred of an IRA owner in 2020 and going forward. So in 2019 and before, the IRA beneficiary in a non-spousal situation had the ability to take required minimum distributions based off their life expectancy, just like an RMD table for 70 and a half. There was an RMD table that went all the way down to age 0. That allowed them to take that small portion out and leave the remaining portion to grow tax deferred until they needed it. They always had the flexibility to take out more. They just couldn't take out less. So that was an option that gave a lot of flexibility, and really for a high earner was the most appropriate option, because it's not pushing their income taxes into a higher bracket on their earned income, as well as pushing those beneficiary income taxes to a higher level as well. But now that the Secure Act is passed, after 2020, for any death that happens in 2020 or after, that option has been taken away. So what does the beneficiary, what are they required to do? So post 2020 post-Secure Act, they have to go through and take that distribution over 10 years. Now, we're speaking of just non-spousal beneficiaries here. So it does not apply to people that have spousal beneficiaries, for beneficiaries that are disabled, for minor children, as well as beneficiaries with less than a 10-year age difference from that IRA owner. So, before the Secure Act, we talked about how that was passed on to the next generation. And one of the biggest issues and concerns, is what if, that person doesn't have the ability to structure out those income distributions. So, if you think they can go through and pay the taxes in full, they can take it out over their life expectancy, as we discussed, per those required minimum distributions, or they could take it out over a life expectancy in equal installments via the form of a true annuitization over their lifetime. So substantial equal periodic payments for as long as they live, just like a life-only annuity. So they're able to really have two options to stretch out the taxes. What is one of the big problems there is, what if those beneficiaries are spendthrifts? And when we spoke about those opportunities or ways to distribute an IRA via stretch, one of the biggest things that clients came back with or concerns was, what if my kid is going to go out and buy the Corvette? They're going to go out and buy, a yacht. They're going to go through and spend it on things that's not in the intention of that IRA owner, and then thus put themselves maybe in even further financial burden by taking on additional debt or spending on those assets, but really not what they're designed for, is creating that legacy onto the next generation. And so, that's kind of where the stretch concept came out. And so, the options for beneficiaries now, are they pay the taxes in full when they receive that death claim. So all in 1 year, a 1099 is generated, and more than likely going to move them, unless they're at the top tax bracket, at least 1 to 2 tax brackets higher, and not only their earned income that they're making through wages and earnings, but also on that death benefit proceed. The second is the beneficiary pays taxes in year 10. The IRS allows them to defer those out for a maximum of 10 years, but at the end of 10 years, that IRA has to be dispersed, and that's when the IRS is collecting those taxes. So one thing to think about around that is, what is the ability for that beneficiary to take and reinvest, let's say, that beneficiary IRA post death of that IRA owner? And I think there's a lot of questions out there in the marketplace around what options are available. Can they reinvest? How are companies administering those beneficiary IRAs? Some are saying, we're not going to give them the option to move the asset post-death. They have to keep it here. They have to keep it in the vehicle that it's in, because then we know how to track how long that 10 years window is. And other custodians are saying, I can't track on how long the date of death is. I don't have it in my systems yet. So I think more to come, and I think there'll be more flexibility down the road, but definitely something to think about and talk to those IRA custodians today is, what are those options if the beneficiary wants to defer through year 10, and then finally they can take out 10 equal installments over that 10-year period of time, and that would be the third option that's typically out there. But there is one more option. That one more option is a life insurance solution, which can go through and give that beneficiary more control, take and not leave the tax burden behind to the next generation as well. And Lena's going to talk about how that's structured, if you do it, if you don't do it, and some of the tools that we've made available at Global Atlantic to help you present this complex idea in a more simplistic and visual format. So Lena, I'll turn it over to you. Lena, I believe you need to unmute
Lena,
the line.
I think you're on mute.
Sorry.
Lena.
Okay. Thank you. What I was saying is, thank you, Brad. That was a good overview. So what Brad was leading to was, obviously, life insurance is a great solution in the right situation. life insurance is a great alternative because what it does is it allows you more flexibility without the worry of trying to figure out, will that beneficiary, your son or your daughter, somebody who's not a spousal beneficiary, will that beneficiary end up being a spendthrift with the money? Or will the beneficiary get the right kind of information to know what options are available at that time, or will they just end up paying taxes all in 1 year? And so the life insurance comes in to help answer a lot of those questions. So let's say you inherited an IRA account. There's a tax problem, and there are really two. One is the beneficiary who receives it, assuming it's a non-spousal beneficiary, like a child or a partner. That non-spousal beneficiary will receive the IRA and have to pay federal income taxes. And as Brad explained, all at once by year 10 or over the period of 10 years. But when the year 10 comes around, all the taxes have to have been paid on the entire amount, whether they like it or not. And that federal income tax is a lot, whether you pay it all in year 1, you pay it all in year 10, or you pay it over time and you manage the taxes, it's still a lot of money. And so that tax is the responsibility of the beneficiary. And if the beneficiary, depends on what the beneficiary's tax rate is at that time when they take those distributions, and those distributions are forced. Currently, we're at the lowest tax brackets between 0 and 37%, 37 being at the highest rate. Likely those are going to go back up. So that is, if a beneficiary received $1 million IRA, for example, and they're in the 37% tax rate bracket, then that's $370,000 that would be owed on that $1 million of receipts. So think through it that way. The second tax problem is, and most of the time, the cases that this works for is if you have an estate tax problem. And as Brad mentioned, people thinking about IRA max basically have an estate where they have plenty of income. They know that they've carved out this particular IRA that they're not going to need for income anymore. And so they're just going to put the beneficiary to be the child or children on that IRA. And so that IRA they own when they die. And so that is includable in their estate. The top estate tax rate is 40%. So that's another cost to using an IRA as a legacy vehicle. Now, the beneficiary does not pay the estate tax. Well, indirectly it does. We'll talk about that in a minute. The estate pays that tax. But the bottom line is, if you have an IRA and you keep it and you transfer it via beneficiary designation at your death, you will have these two taxes that will eat away at the principal that was intended to provide an inheritance to the child or children. And so one of the ways people over the years have managed taxes before the Secure Act was to say, you know what, if I give it to Johnny as beneficiary, yes, he may spend it all. So what I'll do is I'll name a retirement plan trust, a see-through trust, as the beneficiary of the IRA, and then Johnny will be a beneficiary of that trust. And so they would use the retirement plan trust to make all those decisions. The trustee of that trust would make all those decisions to be able to say, okay, let's stretch it out over your life expectancy, as Brad was mentioning. Let's stretch it out over in equal installments. Let's make distributions in a certain way. And the trustee would have discretion and responsibility to make sure that that money lasted, that it grew as a fiduciary for Johnny, the beneficiary. Well, currently, that's really tough under Secure Act because there's really two types of trusts. There's the conduit trust, and then there's the accumulation trust. And this is really, really tricky. I think it's important for you to just have a general understanding of these two trusts now so that you can explain the positioning of life insurance as a positive alternative in the right situation to having an IRA as an inheritance vehicle. You see, right now, if you have a conduit trust, that conduit trust has to be distributed all by year 10. All the money in there has to be distributed under the Secure Act. And so when you distribute it, you can do it over 10 years. You still have those three options. You can distribute it all at once. You can distribute it in year 10. You can distribute it over 10 years. So the trustee can still manage that situation so the spendthrift child doesn't end up just not knowing the rules and spending, paying the taxes and spending it down. And that is, the taxes are based on when the distributions are made in those 10 years, the taxes on those distributions, and no matter what amount they're made, are based on the beneficiary's tax rate, that 0 to 37%. However, in the accumulation trust, this has always been an issue because it doesn't say that you have to pay it out over a period of time. You could actually pay it out over, any amount of time. But with the Secure Act, what it's saying is that no matter what, the distribution from the IRA that goes into the accumulation trust has to be all taxed by year 10, regardless of the fact that it's in the accumulation trust. That trustee has to say, oh, by year 10, all of this has to have been taxed. But this is the kicker. In the accumulation trust, the tax is at the trust tax rate. And the highest tax rate for in the trust bracket is 37%. And the 37% kicks in at $12,900 of distribution. So anything above $12,900 in distributions is automatically taxed at a flat rate of 37%. So if you had $1 million there, every time you made a distribution, you're at 37% right away. So the accumulation trust doesn't work that well. The money could still stay in the trust, and then after it's all been taxed, then it could be the trustee could manage that over any number of years, 20, 30 years, 15 years, to benefit the beneficiary. The bottom line, though, is all the taxes will have to be paid by year 10 or recognized by year 10. So that 37% is a fixed cost, so it really doesn't make any sense at all. I just recently read a trust where it was just done after the Secure Act, and the attorney still created the accumulation trust. So I was talking to the advisor about why was the accumulation trust, if it's still 10 years, it all has to be paid. You know, maybe the beneficiary has a lower tax rate if they had created a conduit trust at least, and then they could, even though it has to be distributed over 10 years, they're, applying a lower rate. It's just unconscionable to have a 37% tax rate apply to the distribution. So it's important to know that even though the retirement plan trust, one of those two types I just described, can still be used as a beneficiary of an IRA to benefit a child as a non-spousal beneficiary of an IRA, they're limited in how much they can work. And if they do work, then the conduit trust probably makes more sense, except that the beneficiary would have to receive everything and it would be outside of the trust by year 10, whereas on the accumulation, it can stay in there, but all the taxes have to be paid at 37% inside there. So it's not a good situation to have trusts any longer. Those trusts were meant for stretch IRAs, and stretch IRAs, where you can stretch them over the life expectancy of the beneficiary, don't apply anymore if it's a non-spouse. They still apply to a spousal beneficiary, to a minor beneficiary, and to a beneficiary who's disabled, so they still work and you can still stretch them out over their life expectancy, but they don't work for other types of beneficiaries. So that's the backstory to give you context of why IRA Max is even more appropriate given a situation where the IRA is no longer required for income by the IRA owner, mom and or dad. Okay, so let's look at mom's
Lena?
IRA during, yes.
This is Brad. I just wanted to give a quick comment of, during these times where we've been, social distancing and such, and, a lot of advisors have been looking for ways to communicate or reasons to communicate with their clients. And, going through and looking at, beneficiary designations has been a key way of saying, let's just make sure your beneficiaries are updated. And if you do see that a trust is designated, it may be a good time to talk through what we're talking about today. And so I've had some advisors have some success of opening up discussions around the IRA Max when, they've had trusts, designated as beneficiaries, and educating the clients on, what their limitations now are of those trusts. So just a good thing to maybe think about under any circumstance, but right now is we're looking for different ways to communicate. It may be more timely than ever.
Yes, and what value that would be to be able to bring this up, you know, Secure Act, it was effective January 1st. Maybe that, you know, trust you have as beneficiary of your IRA doesn't make sense. Let's look at who the beneficiary is, whether it's the beneficiary itself or it's the trust on behalf of the beneficiary. Really, let's look if that makes sense. Great point, Brad. So let's say mom has an IRA account and during her lifetime, and she takes taxable this is the IRA max strategy. She takes taxable distributions to purchase life insurance in the ILIT. So she does that over time. Now we have structured this in very different ways. One way is to say, what about if we have mom deplete the IRA by age 85, by age 90, by age next 20 years, depending on how old mom is, or dad, whoever owns the IRA, and they're planning on giving it to a non-spousal beneficiary like their child. So we can set this up in any which way. The other way we can set it up is just say, well, how much is appropriate that you want to take out and just see, you know, how long that IRA lasts. But the point is this, the point is to deplete the IRA to minimize the amount of IRD or income in respect of decedent, which is the federal income tax that has to be paid on the IRA by the beneficiary when it's received. So how can we deplete that IRA amount so the beneficiary gets a lower amount, and how can we deplete it enough so that the estate pays a lower estate tax? That's the key, and we try to figure out how we can do that by taking taxable distributions from and purchasing life insurance to minimize these tax costs. And so we take this into account in our new Design Hub tool that Kyle mentioned and that Brad mentioned. Design Hub is a proprietary software program where we show these numbers that I'm talking to you about on the following pages. You'll see some of the output. So mom has an IRA during her lifetime. She takes distributions. She pays taxes on it, paying those federal income taxes on the distributions. Remember, IRAs grew tax deferred, so they've never been taxed. By making those tax payments today, that's actually a form of a gift that she's making for her beneficiary tomorrow. Anyway, mom takes those distributions, and then the IRA distributions lower the value in the estate, and so the estate pays a lower estate tax and the beneficiary pays a lower federal income tax. Okay, so you transfer more to heirs. So that's before death. Mom does all of that in order to lower the value of the IRA. Post-death, Johnny receives the IRA, okay, but whatever's left in it. But Johnny also receives the life insurance outside of the taxable estate in a trust, because those distributions mom made that took from the IRA during her lifetime went and she made gifts to a trust that are outside of her taxable estate. The trust then purchased life insurance in the form of premiums. And so the the beneficiary of that life insurance trust is Johnny or the children or whoever it is. And so Johnny receives those life insurance proceeds and tax-free, income tax-free. The trust actually receives it to benefit Johnny. The life insurance proceeds are also not subject to estate tax because, again, the trust is outside of the taxable estate, provided that the trust was established properly, and that the distributions from the trust are based on the trustee making those distributions to benefit Johnny or whoever the beneficiaries are. It's not based on the Secure Act, where the IRA has to be distributed over 10 years. And so the life insurance is not subject to the Secure Act rules. The key thing to remember here, however, is that any IRA balance after mom during her lifetime took distributions to purchase the life insurance will go to Johnny. That IRA balance will definitely still be subject to the Secure Act, but the life insurance will not. So the key thing here is you're lowering the taxes Johnny has to pay on the lowered amount of the IRA due to the payment of premiums by mom making gifts to a trust that purchased life insurance. And because that lowered value is in the estate, then you pay less estate taxes. So let's look at an example. Let's say you have a 65-year-old male, $60,000 of annual premium for 10 years on a $2 million Foundation Elite product. Let's say mom says, okay, I've got $1.5 million in my IRA. I'm going to take a gross distribution of $83,000 a year. I'm going to pay 28% federal income tax. Let's just say mom's in the 28% flat rate. That means she pays $23,000 in income taxes. She has $60,000 left. She turns around and makes a gift to a trust that is funded with a global Atlantic policy, and then mom The beneficiaries will receive the life insurance proceeds of $2 million at mom's death. Now, whatever the IRA balance is after the $83,000 were taken out every year until mom's death will go to the heirs. And in this case, we assumed it was $425,000 at mom's life expectancy that was left of the IRA after the $83,000 gross distributions were made, and then she turned around, paid taxes, and purchased the life insurance. So the beneficiaries ended up at mom's life expectancy of 89, getting the insurance, the $2 million plus the $425,000. And so if they did no insurance, then after the federal income tax and the estate tax, then Johnny would get $717,000 net if he paid taxes all at once and received it in that year. So the difference that life insurance made is this $2 million is outside of the taxable estate. It's not paid, it's no taxes on it. Johnny receives that plus the amount of the IRA balance minus any taxes that would have to be paid on that balance. And so it's 2.4 versus 717,000. So you lower the taxable legacy and potentially increase the inheritance with life insurance. Now, this particular slide shows how we show the current situation if you did no insurance. We say today, mom's age, or dad's age, sorry, I think I switched it between mom and dad. Yeah, it was dad. Age 65, 1.5 million in the IRA today. At 89, dad dies, he's got 2.2 million based on 6% growth. Remember, required minimum distributions are required at age 72. It was changed under the Secure Act from age 70. You can see it starts at 72. So even though mom is 65 today, she's not doing anything. She's keeping her IRA exactly how it is. At age 72, she's required to take out this amount of money. She has no choice. He has no choice in this case. And so this illustration shows the distribution taken, the taxes paid, what the amount is afterward, and what the net amount is at the end. Then there's this other page that shows what if you took the distributions today. He took the distributions of 83,000, has a net 60,000 and puts it into insurance. You know, what does that look like over time? And this shows you that the 1.5, you take the 83,000, you pay taxes, you have a 60,000, it goes to the life insurance. And so the IRA balance at death age 89 is 1.4 million on which taxes have to be paid. So we also have in the Design Hub, we show you that 2.2 million when you don't use insurance. Over on this page right here where we show 2.2 is remaining. We show that in the Design Hub here. So estate tax was 2.2 million at age 89, actually beginning of year 90. That's 892,000 of taxes at 40% to make it really simple. Federal income taxes on 2.2 million is 374,000 in that year to the beneficiary. So now mom or dad dies, the beneficiary receives 2.2 million, has to pay 892,000 in estate taxes, and 374,000 in total income taxes for a total of 1.26 million in taxes paid on that amount. What we show in Design Hub is this is the opportunity cost. That 892,000 could have been invested. And we bring it out to 10 years so we can show you, because there are three options, as Brad mentioned. You can either pay all the taxes at once when you inherit your IRA in year 1, you can pay it in year 10, but no matter what, you got to pay it by the end of year 10, or you can pay it over 10 years to manage your taxes. So I brought all those examples down to year 10. I'm going to show you each one. But if you look at this first column, the opportunity cost is that 892,000 growing, for example, we can assume anything here, we assume 5%. By year 10, the heirs would have lost 1.4 million because you had to pay 892,000 that couldn't grow at that 5%. And then we compare the three options. We compare saying if you paid the taxes in year 1 and you grew that out that net amount in any side fund that you received after you paid all your taxes, you're done. You don't have to pay taxes in the future. At 5%, you would have $3 million, for example, in each of these 3 samples. The second option is to pay the taxes in year 10. You would have, if you waited and you deferred paying the taxes over that period of time, you would have had $3.1 million. And then the third option, of course, is to pay the taxes little by little over time. And there's an adjustment for the payment of estate taxes, by the way, that we didn't discuss. Anytime you receive an IRA and the estate paid estate taxes, the beneficiary has to pay the income taxes, but gets a slight credit for the payment that of estate taxes already paid. So we just reflect that technically in this analysis. We won't go into that too deeply here. But what this analysis shows you, okay, you have option 1, that's one way to do it. You have option 2, that's another way to do it. This is what you end up in year 10 with. And then you have option 3, this is what you end up in year 10 with. But that's really not what you end up with. So what we show here in Design Hub is you have to take the $3 million under option 1 if you decided to pay it all in year 1 and then grow it out to year 10. You have to adjust that amount by $1.4 million. Why? Because that was the cost of the inheritance. You decided to keep your IRA and give that IRA to your beneficiary. Because you did that, you lost potentially $1.4 million of estate assets you could have given to your beneficiary, because that could have grown. You had to pay the estate tax up front, and over 10 years, it could have grown to 1.4. So whatever you got in year 10 after you paid estate taxes on your, and income taxes on the inheritance of the IRA, that beneficiary got $3 million. They really got $3 million minus the 1.4 they could have gotten. And so their net is 1.5. Same with option 2. If they said, you know what, I'm going to, I don't like the IRS, I'm going to screw them. I'm going to hold on and get deferral all the way to the last minute to year 10. Instead of paying all at once. I'm smart, I'm going to do that. Well, you do. You get a little bit more, right? Because you got to defer it longer. You kept it, we assume 6% because we assume you kept it in whatever vehicle it was in. And it was earning more, so we just kept 6% there. You got $3.1 million. You still got to offset that by what you could have had if you didn't have to pay estate taxes on that inheritance vehicle. And so you're at 1.6 million, still better than this amount. And then the third option is 3 million, and you have to offset it by 1.4. So the bottom line here is that you end up paying more, 1.4 million more as a cost to using the IRA as an inheritance vehicle. It's really not the $3 million that your beneficiary is going to get net of taxes over 10 years. Your beneficiary is going to get the $3 million minus the 1.4, what they could have gotten in addition from the estate. And so we show that because what happens is clients will say often to an advisor, well, you know what, I'll take my chances. They'll grow a lot. It'll grow a lot. They won't pay the taxes. He's not a spendthrift. He'll keep it. He's really responsible, my beneficiary, my son. He'll keep it invested and he'll get a big amount by year 10, pay the taxes, and then he's got this big amount. You can show them, well, even if you waited to year 10 or you managed your taxes over 10 years, you still have to consider the loss, the opportunity lost. And so that sets up the discussion about life insurance. And then we showed that side of it, and I won't go into it, but we basically say whatever the amount of the IRA was at the death of the IRA owner, we can show each of those options on the life insurance side, plus the life insurance, and net out the cost to the estate of still having a residual amount of the IRA left. We take that into account. You're still better off. You're at 4.6 million under option 1, 4.7 million under option 2, and 4.6 million under option 3, inclusive of the life insurance amount. So we set up the stage. If you do have this issue, if you're 60 years old or older, you've dedicated an IRA as an inheritance vehicle for your beneficiary, you have plenty of other income, you've documented that you have plenty of other income for retirement, that you just want to save this, you think it's going to be a windfall for your beneficiary. We're just here showing you there could be an alternative situation where you get more money to your beneficiary, you minimize the taxes, you actually use that IRA today, reposition it, reallocate distributions today that you pay taxes on, so that tomorrow there's this side fund in a trust with life insurance that is not taxable that goes to your beneficiary. And so this way they can consider that as an option. We've given them every option here, and we can make any assumptions that they want us to make. And so that is the story of IRA Max. And what I'm going to do is, Kyle, did you want to talk about this here before we entertain questions?
Yeah, absolutely. So I do see we have a few questions that have been sent through, and we'll go ahead and ask Lena and Brad those. Before we get to the questions, just wanted to promo the next week's upcoming summer training camp, and the focus is going to be on premium finance. And we have that broken down into kind of two sections. So the 11 a.m. Section next Wednesday is going to be kind of that premium finance 101 discussion. So we'll kind of overview what premium finance is, some of the do's and don'ts, the benefit of those, and kind of structurally build up the training to move into session 2, the 201, where we'll dive a little bit deeper. Also, 201 will have not only the perspective from the insurance company, but we also have a premium finance lender that's going to be co-presenting that with us. So a great way to get a perspective from the insurance company as well as on the lending side on kind of those premium finance designs and transactions. So definitely check that out. You should be getting an email tomorrow with registration links. I do highly recommend that you do register. One, it creates a meeting in your calendar, and two, we definitely want you to join, and attendance is key. But for some reason, if you're unable to join by registering, we get you on a list. So even if you don't join, we'll send you the recording of that session that you can check out at another time frame. So I'll be looking for that email tomorrow. Get registered, and we hope to see you next week. So we are going to open up for some questions. Use that Q&A feature, submit those questions, and we will divvy those up between Brad and Lena. So one question I saw, go ahead.
Yep, go ahead. I saw the questions if you want. I'll answer the second one, then I'll go back to the first one. Why a trust? That's a good question. So typically, today, you may say we don't need a trust, right? Because the exemption amounts are so high. By exemption, I mean, you know, the 2017 Tax Act increased the exemption amount before estate taxes applies, just generally. It's huge. So if you're a married couple, estate taxes aren't going to affect you if you're worth 23 million or less. If you are an individual, then it won't affect you unless you're worth 12 million or more than 12 million, or it won't affect you as an individual because you get to exempt 12 million or less. So I think I said that wrong, but anyway, 12 million for an individual and 23 million for a couple are the exemption amounts from estate taxes. Anything above those amounts when you file your estate tax are subject to estate tax. Okay, well, that's going away. It's expiring per the 2017 Tax Act in 2026. So the last day of 2025, December 31st, right before midnight, is the last time you can make gifts to utilize those exemption amounts. But things may change depending on what happens with the administration too for estate taxes. But the bottom line, the 2017 Tax Act tells us that in 2026, that 23 million and that 12 million are going to be cut in half. That means a married couple worth more than 12 million will be subject, their estate will be subject to estate tax, and an individual worth 6 million or more, their estate will be subject to estate tax. So what you have to do is consider two things. One, will the client have an estate tax problem above 6 million or above 12 million by year 2026? How old are they? Consider that, because they could have an estate tax problem. And if they do, you're going to want to have the life insurance outside of the taxable estate. The second thing is that if you use a trust, you have the ability to manage the distributions for the heirs. So that's very important. And because this particular strategy is mostly for people who have an estate tax problem. Not always. They could be close to an estate tax problem, or they could be, you know, if they're worth 4 or 5 million, it can still affect them, and so they could still use this strategy. But in all likelihood, the people who use this strategy will probably be close to the estate tax problem. And so you wouldn't want to have life insurance subject to estate taxes. But there's a possibility where it wouldn't be. So you have to look at it based on your case particulars. So that's why I talk a lot about the trust. The living trust, if it is irrevocable, I thought it is tax-free. Okay, so no, so a living trust is a revocable trust. A living trust is a trust sometimes that we create to put our home in, or if something happens, just to have all of our assets in the trust when we die, so that it's non-probatable, so that you could quickly get access to assets in there to do the planning that you need. So you don't have to go to a court and figure out, you know, what assets are there before taking care of certain things. So a lot of people have their homes, for example, in a living trust. A living trust does not take anything out for estate tax purposes from your estate at all. An irrevocable trust does. An irrevocable trust can be set up in many, many different ways. We won't get into it, but an irrevocable trust says you're placing assets, making a gift or a sale or however you do it, and you're moving those assets from your estate into this trust, and you're saying, I will never have any access to that trust again. I'm giving up complete ownership of it, and there's different provisions you have to put in there for that to be the case. And so in that way, the IRS says, okay, you gave up all rights to that when you put it in the trust. We're not going to tax you on it. Of course, things happen all the time. The trusts are drafted incorrectly. Things will, you know, somebody has access somehow. You know, there's all kinds of things that can happen. But bottom line is, if you structure a trust properly and make it irrevocable and make it so that you have no ownership in the principal asset of the trust, even if you're taxed on its income, you could still have it irrevocable and not have it included, any assets in there included in your estate. It has to be irrevocable. If it's a living trust, anything in that trust is going to be included in your estate. So I hope that that answers that question. What is the relationship with the conduit or accumulation retirement plan trust? Okay, so the accumulation and retirement plan trust really is outside of if the IRA ends up in your estate, it's still going to be estate taxed, even if it eventually passes to the conduit or accumulation trust. It's still going to be estate tax, so you're still going to have that tax. The conduit in the accumulation trust is to benefit the beneficiary, so that the distributions from the IRA after the parent dies or the IRA owner dies can go over time for the health, education, maintenance, and support of the beneficiary without the beneficiary having direct access to it and spending it all at once. But, you know, it's more to manage the money for the beneficiary. But it doesn't do anything with regard to the IRA, because the IRA itself is still owned by the IRA owner. Now, there was another question, Kyle. Did you delete that one?
You already answered that one. So.
Oh, I did? Oh, okay.
Yeah.
Okay.
Yep. So we've cleared the questions. I think that we've just about wrapped up our time. If you have any additional questions about this, I mean, this is a great way to also, you know, shine some light on Lena and our advanced sales team. So obviously we were focusing on a specific concept, but we have a full support staff on the advanced markets and advanced sales team that can help assist you with these type of questions. And, you know, if you have case specific things that you need help with, I know we were talking in generalities and kind of a lot of these conceptual things, but, you know, as you want to drill down, you know, things that you need help with on a specific case, reach out to Lena and her team. They're a great group of people, and they have a ton of knowledge on these types of things, and are more than willing to help you out in kind of whatever phase you are of kind of that case design, you know, fact-finding questions, any kind of assistance that you need. Definitely reach out to our team. We'd be happy to help you out with that. So I do want to thank Brad and Lena for their time today. I hope you guys enjoyed the content as much as I did. I think they did a great job. We will get a recording of the session out to you as soon as we can, so you can go back and use that as a reference point. And as always, we do thank you for your business. We thank you for your partnership. Let us know what we can do to help you guys out, and have a great rest of your day. Thank you.
Thank you.